We've been talking about how the market is getting ready for a decision on interest rates from the U.S. Federal Reserve this week. And no change in rates is expected. In fact, the bigger story has been how increasingly traders are expecting the Fed's going to have to push out rate cuts because of a resilient U.S. economy. Now, here in Canada, we have seen some signs of a cooling economy. We're about to get our latest GDP numbers. For more on what to expect and what that means for the Bank of Canada, we're joined by Holt. He's Vice President and Head of Capital Markets Economics at Scotiabank. Derek, great to have you. When it comes to the GDP story, and we get some numbers tomorrow, what's your expectation?
I think they will feed the rebound narrative on balance, and that's a bit of a shock to the Bank of Canada. Remember, Governor Macklem had been saying for some time that the peak pain for the Canadian economy would impact us in the first half of 2024, and that's not exactly working out so well for them. We're getting first quarter GDP growth probably in and around 3% in inflation-adjusted terms on a quarter-over-quarter annualized basis, and we know January GDP was up a whopping 0.6 after only a 1/10 contraction in December, and so the rebound had very little to do with the end of the public sector strike in Quebec. There was much greater breadth to the rebound into the start of the year, and then we tacked on another 0.4 growth into February, according to StatCan's preliminary guidance for that month that we'll see firmed up tomorrow with greater details. I think we could end the quarter a little bit softer. One consideration being that the Good Friday Easter weekend occurred a little bit earlier, so depending upon the nature of the industry and business, they lost between 1 and 3 days of selling activity compared to traditional seasonal adjustments. So we'll see whether or not StatCan can comfortably control for that, and there will be a debate around that. But on balance, I expect a pretty decent first quarter, a lot stronger than the Bank of Canada expected coming into the start of the year.
Now, how would you compare Canada's economy right now to the U.S. economy?
Well, there's no doubt in the past year or so the U.S. economy has outperformed. I mean, for a few reasons. For one, the U.S. consumer sector has the best finances in decades, and so that's allowed the consumer to keep on spending as a key driver of that. They've also had much faster productivity gains than we've had in Canada. They've been on fire for the 3 quarters to end last year. They'll probably suffer a bit of a setback when we get the Q1 numbers this week, but the trend is much more favorable in the United States. They're getting more output with the same or fewer inputs, basically, in terms of what's driving GDP growth. But in Canada, I still caution. We had a number of unusual effects last year. Wildfires, an enormous number of hours worked that were lost due to strike activity, unplanned maintenance and repair and activity going on at petrochemical facilities, auto plants, mines. A lot of this kind of activity was severely disrupted the data for reasons that had nothing to do with interest rate hikes. And so there's a bit of a blended story in terms of Canada's underperformance.
Okay, I guess one of the reasons I'm asking is if the takeaway from the next GDP numbers is that Canada is navigating relatively well, but there's this growing dialogue around the Bank of Canada cutting interest rates potentially well before the U.S. Fed. What is the initiative or what allows the Bank of Canada to make that move, to go ahead of the Fed if ultimately that does happen?
Governor Macklem. In short, he's a dove at heart, in my strong opinion. We saw him talk through the inflation risk through the early days of the pandemic and give speeches about pushing the frontiers of fully inclusive maximum employment. He paused a little bit prematurely, going back over a year ago, 16 months or so ago. Now, on the back of 3 lousy months of soft core inflation data, he's talking rate cuts or intimating as much. And so this is very much a governor-driven issue. I think if he does cut prematurely, or if it is premature, it's my belief that he is doing so prematurely. And if he goes too far ahead of the Federal Reserve, then it could be 1 or 2 cuts and done. And then we might wind up inflaming inflation risk, especially if the Federal Reserve is not talking about any rate cuts this year, or maybe 1 or 2 toward the end of the year. I think he has to be very careful with respect to managing the currency and the risk that he could punch it north of 140 on a USD CAD basis. And suddenly we're dealing with a little bit more financial stability concerns in the Canadian economy.
Okay, so let's talk a little bit about the currency issue. What is the, I mean, in theory, a weaker Canadian dollar actually would help things like exports, I suppose. But what are the things you're watching on the currency front closely?
Sure. Okay. So I mean, traditionally speaking, it's been driven by energy and non-energy commodity prices, as well as the Canada-U.S. interest rate differential. And there are various ways of approaching that. I like a two-year rate forward perspective on that. But but that model hasn't worked so well in the period of enormous U.S. dollar strength against everybody's currencies. If and when the Federal Reserve does eventually begin to cut, then maybe that takes the wind out of the U.S. dollar sales, but I don't expect that to happen for quite some time. I think even our 50 points worth of cuts from the Fed this year is a stretch call at this point in time. A lot has to go right to even get that modest amount of easing. And so when you've got the Bank of Canada already 50 points below the Fed, potentially widening that gap if they go prematurely, already a relatively weak currency, still buoyant financial conditions given oil prices that are still quite high, then I think you run the risk of the Bank of Canada unmooring the Canadian dollar, unmooring inflation expectations, and driving a renewed round of inflationary risk effects as we go forward.
A lot